Hey everyone, Jim Brees here from GreenGrowth CPAs, and thank you for watching our webinar. I'm just very excited to share a lot of great content with you about mergers and acquisitions in the cannabis company. This is the second part of our two-part series. We covered due diligence first, and now we're doing business combination and integration. So a lot of great content. Going to cover the finances, the people, the culture, the policies, the procedures, all the things that you need to get a 30,000 foot look at while you're doing your M&A in the cannabis industry. If you have any questions, please reach out to us at greengrowthcpas.com or give us a call at 800-674-9050. Hopefully you enjoyed this presentation. Hopefully it brings you a ton of value. And if you have any questions, again, reach out to us. Let's hop right in. Hey everyone, welcome again. One more time, I want to thank you for joining us today for our webinar about mergers and acquisitions in the cannabis industry. This is the second part of our two-part series, business combination and integration. So after you make your deal, after the due diligence is done, we then have to talk about integrating and combining these two businesses, maybe even three or four if you do a very, very large M&A deal. But in most cases, this is going to be two entities coming together, creating that marriage. So before we hop in, I just want to explain to you a little bit more about GreenGrowth CPAs. We are a cannabis-only firm. Specifically started off in tax, but we have branched out into all other aspects of finance and cannabis. So we have a thorough and deep understanding of tax, compliance, and assurance-related requirements for the cannabis industry. We prepared over 1,200 annual tax returns for cannabis operators spread across all the different verticals: dispensaries, distribution, cultivation, manufacturing, delivery, testing, and we just eclipsed the 400 cannabis business client mark. So a lot of people working in 12 different states, operating in California, Oregon, Washington, Oklahoma, Montana, many different states, lots of different types of operators at all different stages of their business. We've also done 15 audit-related and valuation projects in 2018 and 2019, which ties into this M&A. We've helped people do the due diligence on the businesses, the actual valuation projects after the due diligence, and then auditing any other financials and documents that are relating to when you combine these businesses. Is everything going the way it's supposed to be going? So we have a lot of experience how these deals work in the real world. This is not just theoretical stuff. This is actually from the front lines, from Marco Glisick, who is our audit partner, who's really broken down some of these deals and given me a lot of his insight, again, from the front lines, from the operator standpoint on both sides of the transaction, the buyer and the one being acquired. So it's very, very helpful to get this information, especially if you're not at the point now where you actually want to move forward with one of these deals, but you're setting yourself up for the next 12, 36, 72 months from now to be acquired or to acquire one of your competitors potentially. So before we get started, I need to let you know that the information contained in this webinar presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's hop right into today's agenda. So first, we're going to be talking about due diligence. We're going to review all the stuff we learned in the first part of this webinar series, and then we'll go in discussing what's the difference between a merger, an acquisition, and a consolidation, and then jump into different aspects of business integration. So how do you bring the accounting and finance numbers and reporting all together? We'll go through some examples of that as well. And then we'll hit on people and culture. How do you integrate the actual people behind the business? Because businesses are not just robots that kick out results. It's people behind the business that make it valuable. And then how do you integrate and pick which policies, processes, and procedures are going to stay and what needs to go? So let's just quickly cover due diligence and what is the actual point of due diligence. So due diligence is used to prove the legitimacy of a business. Since we've been into a gray market for a long time, mostly illicit, a lot of numbers, are being taken on just the trust factor between two people. And to increase the value of your business, you need to create documentation along the way, or if you want to expect a premium for your company, you're going to need to create documentation all the way to prove the legitimacy of the numbers behind your business. Again, that documentation impacts the price, premium, or discount of that business. Now, when you look at due diligence, it has three major prongs. You have the balance sheet, the P&L, and then the intangibles or other aspects of the business that you need to look into. So real quickly with balance sheet, you have the assets. These are the things you're acquiring, things like cash on hand. Do people have cash logs? Verifying other cash positions such as banks, merchant accounts, accounts receivable. How good is the history of their bad debts? Or how bad is it? How long are they giving it? How much credit are they giving to their customers? How clean is the books for their inventory? What's the age of their inventory? And what's the inventory counts and quality of that inventory? Then you look at fixed assets, the title to the assets, do they even own what they say they own, and the facility. Are they actually building out and using the full capacity of their facility, and is there any additional cost to building out that facility? Then you look at liabilities. These are the risks that you're exposed to. So accounts payable, getting a whole list from the accounting team of what the bills are every month and totaling them up, and then finding any unrecorded liabilities that may pop up after the purchase and getting explanation and clarity around that. Then looking at the debt arrangements for the business or any funding that came in, and this is where you work with in-house and outside counsel to find out what you're really signing up for and who you really owe money to. You also dig into the leases, which is the length and the price of those leases, because you need to know, hey, if I am buying this business, am I staying here permanently or do I need to move in the next 27 months? Then you look at legal claims against the company. These could be employee wage disputes, customer issues, contractor issues, and then lastly, one of the most important things is taxes. Are all the jurisdictions filed properly? This is where you got to get the returns, dig in line by line, making sure that the calculations to get to those returns were done right, and understand if you owe any back taxes, because if you do, there's penalties, interest, and all that stuff that comes along with not paying your taxes correctly. Then you move on to the P&L, looking at revenues and expenses. So revenues, what are the non-recurring and recurring revenue aspects of the business and how much falls into each bucket? Then you're looking at trends of average transaction size, frequency, how many new customers are being added. And then you look down at the expenses and you break that down by product, finding out what's the gross margin by product or by service line. Then you look at recurring expenses like the SG&A. And then you also back out personal owner expenses, because you'll see this commonly with private companies that the owner is running their personal food expense, their lease, their mortgage, their car, and anything else, travel and entertainment expenses. So you need to back that out. And then finally, you create a financial model and pro forma financial statements to create a fair value offer for the business. But before you do that, you then look into other aspects of the business to really tweak that model, because you don't want to make an offer without knowing some of these other intangibles. So those intangibles, real quick, we'll go through. Entity type and structure. Are they LLCs, S Corps, C Corps, nonprofits? Do they have 1, 5, or even 20 entities? And how do the funds flow between those entities? And what's the governance structure? And how is everything set up? Then you look at licensing. What type of licenses they have? What expiration date they have on those licenses? Any temporary and provisional licenses? How are the fees structured? Are there any revenue share agreements built upon those licenses? And who are you actually doing business with if you have a revenue share agreement? Then you look at lab tests, looking at the product integrity, understanding the brand awareness and the marketing. What's their social presence? How are people speaking about this brand or this company online? What's their sales team like? What's their pipeline like? Are you going to buy a company where the CEO is making all the sales and once they're gone, you have an empty pipeline and no business actually to make money from? And then lastly is key team members. You need to understand the internal knowledge by interviewing the people that are in that business that make it work and planning for your stay-on bonuses, which is something you'll add into that financial model because that is a cost of acquiring this company. So again, once you have all three prongs worked out, you can then make a fair value offer to the owner of that business and then take that business over if you guys or gals come to a deal. Now, I want to explain the difference between a merger, an acquisition, and a consolidation. So a merger is when two or more companies come together and combine forces where the company that's actually doing the takeover is left as the existing entity. And this typically happens when the companies are same-sized in nature. So there are three types of mergers that you can think about, right? There's a horizontal merger, and this happens when both companies are in the same line of business, which means that they're usually competitors. So an example of this would be Vaporizer Company A buys Vaporizer Company B because they like the product or they see that they're, catching ground on them and they want to acquire that customer base or acquire that brand or acquire that type of customer. Then you have what we call a vertical merger. And this happens when two companies are in the same line of production or the same line of work, right? Like in cannabis, but stage of production is different. So an example of this would be a cannabis manufacturer or processor buying a cannabis growing company. And that would be to, again, vertically integrate their business more. And the third one we have here is a conglomerate merger. And this happens when two companies are in totally different lines of business. And this kind of merger usually takes place in order to diversify and spread the risks out. And in the case of the current business, actually stops yielding adequate profits. So this is not something you're going to see soon or right now in the cannabis industry. You'll usually see this, later in the more mature part of the industry. And so an example of this would be if General Motors were to buy Tilray or General Motors were to buy Canopy, right? Car company buying out a cannabis company because maybe they know, hey, in 17 years, cars are going to become such a premium. People are going to be relying so heavily on the sharing economy or having automated cars and that they don't need to have their own car, that we should diversify and get into this cannabis space because we can make a lot of money doing that. Let's spread our risk out. Again, you won't see that until this industry really, really matures, and especially until it goes federally legal. And then you have an acquisition where one business buys a second one, or one smaller than them is absorbed into the parent company. And this is more common today, right? You'll see this a lot. It sounds similar to a horizontal merger. And then you have a consolidation. And this takes place when two companies come together, two ventures come together and combine forces and join into one completely new venture. So it would be like company A and company B come together and create a whole brand new company, which would be company C. So now that you understand the difference between a merger, an acquisition, and consolidation, let's now talk about the aspects of business integration. After this deal takes place, what are you really doing to make sure that these all come together? So there are three main aspects to this. You have accounting and finance, people and culture, and processes, policies, and procedures. Now with accounting and finance, the goal is separate books but unified processes and reporting. In financial accounting, consolidated financial statements provide a comprehensive view of the financial position of both the parent company and its subsidiaries, right? The company that it bought if it stays its own entity, rather than just one standalone position. And when unifying, you're trying to gain efficiencies in the processes, right? One accounts receivable department, one accounts payable department. Instead of everybody doing everything separately and creating these silos, you want to create unity and have one base, and we'll dig deeper into that. Then you have people and culture. Again, as I said earlier in this presentation, people run businesses. They're not robots. It's not just a bunch of computers making this up. People run this, and there's a culture that keeps those people together. So the goal is to preserve the cultures within the companies, and that depends on, how old the acquiring company is versus the company that is being acquired. So you have to play this in a very sensitive manner, and sometimes these cultures have to stay very far apart from each other and live separately, but sometimes the goal is to bring a unified culture and allow that parent company's culture to diffuse and go into this acquired company so that they can again mature and grow. And usually these companies that are being acquired are the smaller ones, the younger ones. Startups are usually being acquired because big conglomerates or big companies can't be as fast and as nimble as these startups. So when you get a startup that's kind of like a cowboy or cowgirl that's been out in this gray industry for a long time, and you get acquired by a very straight and narrow, bigger company that's maybe publicly traded, you have to kind of absorb some of that culture of being like, hey, let's really straighten up here and let's get our stuff together, and we can't just fly by the seat of our pants. We have to, new HR policies and all things like that. And then that leads us into the third part, policies, procedures, and processes, where it's going to be hopefully a meritocracy. The best processes should come out on top and be utilized throughout both organizations, or all three or all four, depending on how many companies are operating under that parent company. I don't want to create too much stress here because there's no one right way to do this. You have to use context and awareness of the entire situation to guide you through a graceful merger and acquisition. And as we'll talk about in a slide or two later, is that it's not always a very pretty picture. It can become very hostile. And there's lots of factors to determine the outcome of how this actually plays out. It's dependent on the transition team and the people that they are guiding and the products that are coming together and the product lines and the verticals that are coming together. Because if you have a bunch of growers that are buying a manufacturing company, they may see something going a certain way without that built-in knowledge, and they try to impose their processes or how they quote-unquote think it should be without actually having that front lines experience. They just know they need to buy a manufacturer. Then you have the laws that come into play, and even the micro and macro market conditions that can play into in understanding how this all actually plays out and shakes out. But I'll give you something as a word of advice from a few of these deals that Marco said. Really stay optimistic, but don't be delusional. Patience is the key. These things don't happen overnight, and it's a slow process. It's a very time-consuming process. So be patient and have a simple plan at least, because a simple plan executed violently is better than having no plan at all. Use experienced professionals to guide you throughout this process and make sure that you're not missing large stepping stones in the medium-sized steps or those even larger steps or the small steps so that they don't come back to bite you later. So let's jump into the accounting and finance integration. Again, the goal is separate but unified. So what I would suggest is that you appoint a CFO or VP of accounting and finance to oversee the integration process. And in most cases, this will be an internal person from one of the two companies, whoever usually has the strongest financial performance and controls. But this could be an external person, like an outsourced CFO, like GreenGrowth CPAs, like us. We've held this position in a few of these M&A deals and helped this come along and move along gracefully, because having a third party can actually relieve some of these conflicts that when you put two very strong-headed CFOs together, having that mediator in between really helps to create a unified financial process and financial congruency between the two businesses. And experience in this will be critical to successful implementation. Not always are you going to have the ability to bring in experienced CFOs from either side that have gone through an M&A, but if you can, I would highly suggest tapping them on the shoulder and see if they want to take on this responsibility. Now, your goal is to keep the books separate since there's different legal entities, because you need to be able to peel back the layers of the onion and be granular when necessary. And this comes into importance when you need to understand which brand or which product or which actual SKU is performing and who is actually flopping, because sometimes there are 7 or 9 brands under one parent company. And yes, you will report on a consolidated basis that, hey, parent company did $700 million in revenue, but you need to know that company 1 contributed $125 million with 42 employees, and then company B or company 2 contributed $35 million with only 7 employees. And you need to be able to look at these metrics and understand what are the building blocks of that parent company, because at some point, a company you acquired, you may want to actually sell that off. And when they do the due diligence, they need to see that granular data. So this is that separate legal entity needs to have their own books, but we report on a consolidated basis to whoever needs to see those statements. And to make things easier, you're going to want to transition over to the same accounting system, creating an easy way for the systems to talk together and making it easy for your accountants to jive and put and consolidate all these numbers together. So if 3 of the 4 companies are working on 0, then you should probably get that 4th company to move over to 0. Or if, one company that has great financial performance and good strong controls is on QuickBooks and you're acquiring a company that's on 0 or has no accounting system at all and they're just doing it through Excel, you need to transition them over through QuickBooks. And each entity will get its own ledger in that software. It makes combining your books much easier and moving people around much easier. Because yes, it's just accounting, but accountants do have preferences. Some people are really, really good in QuickBooks, or some people are really, really good in Xero. You need to listen to that CFO or VP of accounting and finance that you appointed and get their expert opinion on which system is going to be good for the company now, but as well as for when you grow and become something bigger in the next 2, 7, 10 years. So let's talk about now, once you transition over to that unified accounting system, you need to create consolidated financial statements. So what are consolidated financial statements? So at the end of every period, whether it's a month, a year, a quarter, you're going to need to file consolidated statements with the regulatory body of your country. So in the US, that's the SEC. And essentially, it's just adding financial statements together. Pretty much, all right, all the assets for company A plus all the assets for company B creates this consolidated asset bucket. And you add up the liabilities, you add up all the incomes and all the expenses, and pretty much adding things up line by line to create this consolidated statement. And when doing this, the intercompany transactions need to net down to 0. And if they don't, then you've probably messed up somewhere. So if there's, movements of investments between the two companies, especially in that first year or that first month or that first quarter, those need to net out to 0. And then if you're a public company, you have to present consolidated financial statements. If you're private, you don't necessarily always need to do this, but as a parent company owner, I'm sure they're going to want to see how are we doing in the macro versus the micro between the two companies. And for management, as a public company, you can break down the financials for each company so they can see, again, which business units are performing best and where they need to maybe reallocate some new resources, whether that's financial or people, so that they actually make the improvements in the business, right? Information guides how we deploy our resources, so having that granular reporting is very important as well. But if you're public, you need to have consolidated financial statements, and there's a set of standards for that. So there's GAAP and IFRS, and these guidelines fall under the guidance for acquisition accounting and consolidation accounting. And for GAAP, that's ASC 805, and for IFRS, that's IFRS number 3. And that's a little technical there, but if you want to look that up and you like reading accounting articles and really deep technical stuff, you can jump into that and learn really deep. Again, we're just brushing over the consolidated financial statement stuff because, again, this is really, really technical. We could talk about GAAP ASC 805 for 10 hours and still not cover everything. But one aspect you'll notice in these M&A transactions is goodwill, right? And you may have heard this term thrown around, but I really want to break it down for you because if you do buy a company, you will encounter this term because it's the premium that you're going to be paying. So goodwill is an intangible asset associated with the purchase price of one company by another. And specifically, goodwill is recorded in a situation when the purchase price is higher than the sum of the fair value of all identifiable tangible and intangible assets purchased in the acquisition and the liabilities assumed in the process. So you're going to have those assets, you're going to minus the liabilities out, and then whatever premium you pay over that net number is going to be your goodwill number. So examples of why you would pay a premium would be like the company's brand name, if they have a great solid brand name out there, or they have a solid customer base, or they have great customer relations. People love this company and they're just fanatics about it. Or they have good employee relations. Maybe they have acquired some really great talent and you want to pay a premium to keep that talent within your company. Or maybe they have a proprietary technology and you just really want to make sure that you can use that technology and exploit that technology to the fullest of its potential without having to go reinvent the wheel yourself. Now, a quick calculation of goodwill. Goodwill is equal to the purchase price of the target company minus the combination of the fair market value of the assets and the fair market value of the liabilities. And again, liabilities is a negative number, so you add the assets and the negative liabilities up. That's going to give you one number. You take the purchase price minus that, and that will equal goodwill. So let's just go through a very concrete example. So if your purchase price is $85 million, your assets is $65 million, and your liabilities is 10, then your goodwill is going to be equal to $30 million. And you're going to see goodwill be a pretty massive number in cannabis right now because valuations can be quite crazy because some of these brands that have been in the gray market for a long time have very, very loyal customer bases, and it's really hard to break into a particular area because most of these businesses are local based. And if you are finding that, hey, someone is just owning San Diego, then you should really want to consider just buying that company outright so you can get a very strong foothold in that area. And now you have to ask yourself, well, what premium am I willing to pay for that? On the screen now, you're going to see a very, very high-level example of consolidated financial statements for the purchase of the company. So in this example, Company A is going to purchase 80% of Company B for $100. We keep it very simple like this. We're not going to go to $100 million. Just you can scale this up as much or as little as you want. So you look at the starting balance sheet of Company A. They have $500 cash. An additional paid-in capital is $500, right? That's where the money comes from, right? They're putting that cash in now, and the journal entries for this are going to be a debit for $100, right, the purchase, and then the credit for the cash of $100. Now their balance sheet will look as you see there, cash at $400, goodwill at 0, investment at $100, so their total assets is $500, and assets plus liabilities need to equal equity. So we haven't shown any liabilities here just for the simplicity's sake here, but it's just a thing to note. And you look at an additional paid-in capital is $500, which comes from that top, which is $500, and then the NCI, which is non-controlling interest, that'll be 0 on this Company A, the person who's doing the acquisition. And so you'll notice that assets and equity both equal $500. Now you look at Company B, who's the one being purchased. You'll look at, all right, at 100% interest, they were to buy it, the purchase price would be $125, but they want to buy 80%, so there's 100. We'll take that left-hand column there and we'll just, all right, well, what is 80% of everything that the company has? So you have purchase price, again, $100, fair market value of net assets is 72, goodwill is 28, book value of net assets is 50, and the fair value step up is 22. Now you look at the opening balance sheet. Again, fair market value of assets is 90 for the full company. The goodwill is 35, and then the total assets is going to be 125. Additional paid-in capital is where that investment comes in, and that's going to be that $100. And then the NCI, which is the non-controlling interest, that is the difference, so that assets and total equity equal $125. Now, there are some eliminations. When you start to combine these financial statements or consolidate them, you need to make sure you take those eliminations. So you need to take that $100 off the investment to eliminate the intercompany investment off the parent's books. And then you need to take that other $100 off to eliminate the intercompany investment from parents and additional paid-in capital. And since one is an asset and one is going to be in the equity, they offset each other, so all good. And at the end, you get them consolidated financials. And so the fair market value of net assets is $490. Goodwill is $35, which comes out to a total assets of $525. Then you have the additional paid-in capital is $500, right? That draws in from company A. And then the non-controlling interest is that $25 from company B. So total equity is $525, which equals total assets. Now I know there's probably a lot of questions that come up. I can see some in the chat right now. Again, I'm not trying to be a total education on how all consolidated financial statements look. I just want to get you familiar with a little bit of how this looks and what needs to be considered when combining two pieces of financial data like this. So let's move down and let's look at a second example of consolidated financial statements, which is a high-level monthly accounting example for that first month. So what you'll see here is in month one, we're going to just give some quick assumptions, easy to grasp numbers here. So in month one, $10 in net income for company B. That's going to be $20 in sales and $10 in expenses. And for company A, they're going to have $30 in sales and $20 in expenses. Company A is on the left, company B is on the right, and then we go to the eliminations, and then we have those consolidated financial statements. So you'll see the journal entries there, the debits for the expenses, and the cash that comes in, and the credit for the sales, and the net income and retained earnings for each of those. I don't want to get too deep into them. Then you look at the balance sheet of how the cash shakes out, the goodwill, investment, total assets, and then the additional paid-in capital, retained earnings, and NCI, which is non-controlling interest, and total equity, which is at $510. So the month one income statement for company A is going to be sales at $30, expenses at $20, net income of $10. Then you're going to have the less net income attributable to NCI, which is a non-controlling interest. That's going to be $0. And then you have the net income for company A is $10, which is that bottom number there. I know I went through that fast, but you get to look at this a little bit later and break it down piece by piece. I don't want to spend too much time going over this. But then we look at company B, the second set of numbers there, and that company B is going to have $20 in sales and $10 in expenses. So you'll see the journal entries at the top, the debits and the credits. So we'll look at the balance sheet, fair market value of assets. And again, this number is flowing from that slide we just looked at. So fair market value of the assets, the goodwill that's within the company is 35. Remember that tied in for the number before. So total assets is 135. Additional paid-in capital is at 100. The retained earnings is 8. NCI, which is non-controlling interest, is 27. So total equity and total assets equals 135 each, right? They balance out. Then you have that month one income statement of sales at $20, expenses at 10, so net income of 10, then less net income attributable to NCI, which is coming from that journal entry above, and then you have net income attributable to company B. So if we combine all those together, we still have to do the eliminations of the investment and of the additional paid-in capital, because again, this is the first month of operation. We still need to net out all of those things before we do the consolidated financial statements. And so then you get to this final consolidated statement of the fair market value of net assets is 510, goodwill is 35, 0 for investment. That means total assets are 545. Then the additional paid-in capital, retained earnings, and NCI, all that total up for the equity is 545. And you look at the consolidated month number one income statement, sales of 50, expenses of 30, net income of 20, and that gets you all the way down to total income is going to be net income of $18 there. So again, I know I went over that fast, but this again is just to see how things flow from company A to company B, what eliminations need to be made, and then how you consolidate those financial statements. But when you look at a real company, there's a lot more line items, there's a lot more transactions, there's a lot more journal entries, lots more debits and credits that go into creating these financial statements. And again, we'll have liabilities that play into this, but again, this is a very watered down example of how these will look at a high level. All right. So let's dump into some more information here about when you buy a new company, you need to develop a new tax strategy. So again, you're going to be inheriting many new, what we call financial tools, things like expenses and losses and assets for depreciation, different licenses, which may allow you to do different tax strategies and other things that come along with these businesses. So you need to go on the offense with your tax strategy because as you know, 280E in the cannabis space is your biggest hurdle to jump over and you need to be creative. creative. So a few examples for that would be 471 allocations. There's the 1471 tax code, and that defines inventory capitalization rules for businesses. So if you're a dispensary and you're acquiring a manufacturing license, then you may be able to allocate more indirect costs into COGS in years prior, which can mean huge tax savings for you. So don't wait on this. Jump on this right away. Engage a CPA firm like GreenGrowth CPAs who knows how to allocate specifically, hey, 56% here can be allocated into COGS and 27% of this can be allocated into COGS, and greatly reduce your taxable base, which will then reduce your taxable income. And another example, just very basic, is that if one entity has a loss and one has a gain, then use a consolidated tax return to offset those gains so you don't have to pay taxes on those gains, right? If you're buying a company that's fluttering and it's not really doing all that well, you may want to roll it up all into just one entity and file a consolidated tax return so that you can take advantage of that loss, offset the gains from the very successful side of the business, and then improve over time, save money on your taxes that you can reinvest into that fluttering side of the business, and hopefully in 2 years or 1 year, maybe 4 years from now, it can stand on its own. It's doing really well and it's producing a lot of income. And again, speak with a cannabis-specific tax professional to make sure that you can make the most of your new financial situation. It would be a shame for you to go do this acquisition and then not entertain the idea of a new offensive tax strategy to save you a lot of money on your taxes that you can, again, reinvest in the business. Or you can use that money to fund the stay-on bonuses for those people that you kept into the business that we'll talk about in just, I think, the next slide or so. And then finally, we get to integrating people and company cultures. When you buy businesses, you have to bring people together. And, maybe you might lose a few people just because they want to leave or because their position is redundant. It's all good. This is just part of business, and that happens. 2 types of mergers out there. You have a friendly merger and a hostile merger, which is sometimes called a hostile takeover. So a friendly merger, and this happens when a board of directors of the company that's actually being purchased agrees to the terms, they negotiate those terms, and they finally accept an offer, right? They want to be bought. Then you have a hostile merger, and this happens when the board of directors attempts to prevent the merger from happening. Sometimes you get a board of directors that just does not want to be taken over, but they have no choice but to appease the stockholders, and they just fight tooth and nail on every little term on that term sheet, and it just becomes a very hard, heavy-handed takeover, and it can create, a sour culture. It can create sourness for the people that are in the business being taken over. But in most cases, you're trying to create a unified culture if possible, but sometimes it's not always possible. One thing that people do, and it's not necessarily, and this is opinion of myself and maybe some other people out there, you can't just go firing people willy-nilly. It creates fear within the business. You need to have a thoughtful plan of why this person is redundant and a thoughtful plan of why you need to eliminate this person and create open lines of communication of the people that you're integrating. All hands meetings work well to remove the roadblocks and bring issues such as hey, am I going to lose my job now that we're selling this company? These are just things that are being discussed, and the sooner you can nip these conversations, or not even nip them, become part of the conversation and not let this boil up and without anybody getting attention to it, the sooner you can do damage control if there is going to be any damage from that. And you will experience some rough patches if you have younger companies and older companies coming together, right? Startups are usually very flat, but older companies usually have hierarchies in management. So if you're an older company buying a startup, there's going to be some friction there when the startup is hey, what do you mean we have to, Mike is now going to be my boss. I've worked alongside Mike for the past 4 years. And then, Frank doesn't like that. Or Michelle is saying, well, why is Sharon becoming my boss? I got hired in way before her, but maybe Sharon is actually better on the soft skills, on the human side of bringing together 2 or 3 or 4 groups of people. So just again, understand that there will be some friction, there will be some rough patches, but address it sooner than later to come out better on that other side. How to really be successful of integrating people and company cultures is during your due diligence, learn who the key people are that need to stay within the business that you're acquiring. Some people have really intimate knowledge of the operations. They have high EQ, right? Emotional quotient, or they have very deep political connections or emotional pull with their respective organizations or the people within their organizations. And you may need someone that has that political pull that you can really lean into when things get tough. right? You're going to review the old annual reviews if those are available, and interview as many people as possible to get a full picture of who you are inheriting into your new business family. Because you got to put the right people in the right seats on the bus. And if you have people that don't want to find their seat on the bus, then get rid of them. Because these people are cancer to your culture, and cancer kills companies. You need to get that out right away. It happens, and it's okay. Don't be too wishy-washy about it, because you're going to be sending a signal to other people. If someone is creating resistance within the company or just being a total jerk about things, if you allow that to go on for too long, even if they're the best salesperson or they're the best scientist or the best manufacturer, you need to get them out right away, because if you want to create a very strong culture, you need to send good signals to the people that are going to be in that culture for a long time, that you will not stand for people that, are cancers to the culture. And what this allows you to do during that interview process is plan for stay-on bonuses and how much that's going to be. You're going to be asking yourself throughout this process, are these people mission critical? If I don't have this person, will my spaceship blow up? And the ranges of these stay-on bonuses depends on their level of involvement with the company, right? You may have a master grower that you need to pay a lot more than to maybe a warehouse manager who may be a little bit easier to replace, right? That master grower may have more intimate knowledge of how the systems are set up, any little nuances to it. But you may have a manufacturer who's like, they helped build this whole system in this process. You can't just let them go. And then you may have some human resources people that are like, really good at recruiting or really good at talking people off the ledge of leaving. So again, it's just getting a full color and context to the people that you are inheriting. I cannot stress this enough. People run companies. It's not just a bunch of assets and liabilities and numbers and computers. People are where the magic happens, and you want to retain as many great people as you can throughout this process. And then after you find the right people, you have to use them to integrate policies, procedures, and processes. So the goal in this part of the integration of businesses during the M&A is to reduce redundancy as much as possible. If you're doing redundant work, you're probably double spending, triple spending. So you're going to look at each division within the company and see who is best and implement their operations and their ideas and their processes. And at this point, you may need to bring in experts, especially if you're buying something simply for the license. And I've seen this many times in the discussions I've had with Marco, because we talk about the projects that we're working on, right? We do a lot of documentation of the work that we're working on, and you're going to see this a lot when licenses are limited in certain jurisdictions. People just want to buy that dispensary license just because they know there's only 6 in this city, so they want to buy that license as fast as they can. So make sure you bake this cost into the total price of your acquisition, the bringing in the experts cost, because if it's cost, maybe $50,000 a quarter to bring in an ops manager to really train everybody who's been in a dispensary before, plan for that. Make sure you understand that full cost. And then at this point, when you're trying to reduce redundancy and you've done that or you found the right processes, you're next going to focus on cross-training and learning, right? Creating a solid set of standard operating procedures, or abbreviated SOPs, and then teach people that. Cross-train them on all the different aspects of the business. You don't want someone to be just, you do want some experts that only play one cog in the machine, but as much as you can create cross-training, that is very, very helpful. And you're going to teach this stuff by, either osmosis between team members, right? Patrick works next to Sally for 6 weeks. He learns all the things. She teaches him some things. He teaches her some things. Between osmosis, everybody learns everything, because you don't want to give the leverage up to one team member. If you have a team member that knows too much and someone doesn't know their job duties, they have way too much leverage in your business. They become a linchpin, and when that linchpin gets taken out, that wheel falls off the cart and you're probably not going anywhere, and your business may come to a screeching halt. That's why it's very, very important to focus on this cross-training and this learning in the business. And again, they don't have to know, 100% of the activity. They just need to know enough to pick up and hobble along until you find that right person to fill that gap. Then once you learn and get this knowledge throughout, you need to develop KPIs and measure the current team's performance relative to their past performance, and projecting and trying to beat that in the future. I've talked about this before, is that, hey, you may look at things in aggregate by these big companies, these big, large scale market studies, and you get real lost lost in the weeds. Like, oh, dispensaries should be making $59.74 per transaction. But that's aggregate. Like if you look at Los Angeles dispensaries, even 5 miles from each other make way different average transaction sizes, speaking to the type of client that they have, the socioeconomic stuff, maybe it's a bunch of tourists in one area and it's regular, normal, everyday citizens that are neighborhoods over there. It's just a lot of different things. So really compete with yourself and your past performance, because what gets measured can get managed. If you have reports on these things, then you see trends, and then you can make thoughtful business analysis, look at these insights, and take action. So for dispensaries, some KPIs are average spend per transaction, customer frequency, gross margin per product, contribution margin per product, and your labor percentage, right? How well are you deploying labor? Then in manufacturing, it could be your manufacturing cycle time, the yields from the raw to the final product, your throughput and capacity utilization, your work in progress inventory and turns, and your gross margins. And then if you're buying a cultivation, you may want to look at, their yield per square foot of canopy space, or their yield per square foot of total space, right? Taking into account all the administrative and other kinds of things that go into a grow. And you could look at their cost per pound, right? Really looking at how much are the inputs and what are the outputs are we getting, and normalizing that out. And then their margins for everything that they're looking at. So I know we've covered a lot. We've been going here for quite some time. What has it been? 30, 40 minutes here. So I want to bring this down to a few key takeaways, right? These are very complex transactions. I just wanted to give you a little bit of color and context to what you can expect and some of the different high-level thoughts when doing an M&A transaction. But the key takeaways here, I've got 4 of them. Business integration is an ongoing and multifaceted process. Don't think that this is going to be handled in one quarter or just in one meeting. It takes time. You're going to make some really, really smart choices. You're going to make some really, really bad choices. But hopefully net, things turn out to be a smart moving up into the right operation, and there's a lot of aspects that go into integrating businesses. Secondly, there's no one way to do this the right way. Use context to guide yourself on this journey. Use your instincts. Lean on experts. Make sure you understand that you're not alone in this. You can work with other people who have experience in this, whether it's in the cannabis space or just they've done M&A in other industries and their insights, whether that's just meeting with them for coffee or bringing them in on a formal engagement. And then another point here is that once you do some acquisition, you have a lot of new financial tools in position. So develop a new and offensive tax strategy to make use of those new financial positions and those new financial tools. You can save a lot of money that you can then reinvest back into the business, put you in a much better financial position. And then the last key takeaway here is reduce redundancy, keep key people, measure KPIs, and improve relative to your historicals. Don't overvalue these aggregate studies or anyone's specific opinion about another deal. It's you competing with yourself. Don't look at other cannabis deals and think you're failing. If you're moving up into the right month after month, quarter after quarter, year after year, you're doing well. Could you improve and move faster? Maybe so. But as long as you're improving period over period, that's what you're looking for. So again, I know we covered a lot here, but I want to thank you for taking the time to listen to this presentation. Hopefully it has brought you a lot of value and understanding of what the M&A looks like after the due diligence and after the deal. So if you need help with M&A, with the due diligence side or the business integration side of things, then please reach out to GreenGrowth CPAs today via our website at greengrowthcpas.com or give us a call at 800-674-9050. We really would love to help you make a graceful M&A deal, integrate those businesses, make sure you know what you're buying, make sure everybody on both sides of the transaction is happy, it's a transparent transaction, and things come together to create a really large business, a very large and successful business. So again, if you need help with M&A on the due diligence side or the business integration side, then please get in contact with GreenGrowth CPAs at greengrowthcpas.com or give us a call at 800-674-9050. Again, thank you for taking the time to listen. Have a great day, and we'll talk to you soon.